A Fortune 500 company holds a massive press conference. They've spent $50 million on premium carbon credits to achieve their net zero targets. Exactly 1 week later, a journalistic exposé drops. Those exact same credits had already been claimed by a rival corporation. The market reacts instantly. The stock price crashes, and watchdog groups drag the brand, labeling the executives as greenwashers. Relying on blind trust leaves a multi-million-dollar strategy vulnerable to simple oversight. It turns a net zero pledge into a persistent risk to the company's financial standing. But public opinion is the least of their problems. The true danger is regulatory. Global climate agreements are entering their strict enforcement phase. Frameworks like CORSIA and Article 6 of the Paris Agreement have real teeth. These international bodies do not forgive administrative errors. A double-counted credit on your ledger triggers massive automatic financial penalties. Plausible deniability is dead. Compliance now requires absolute, verifiable proof that your climate impact is real. How does a multi-million-dollar institutional asset get duplicated in the first place without setting off alarms? This outlines the core structural flaw of the voluntary carbon market. It operates on a chaotic patchwork of legacy registries, rather than a unified exchange. These isolated databases have no built-in mechanism to share data. Because they cannot sync automatically, updating ledgers relies on slow, error-prone manual entry from basic spreadsheets. This creates an infrastructural black hole. Verifying across the entire market to ensure a credit hasn't been double-sold is physically impossible for a buyer. Let's track this model of a single, verified ton of carbon. Company A acts in good faith, purchases the credit, and officially retires it inside the first registry. Because the second registry is blind to the first, a bad actor easily lists the exact same serial number in the other database. Company B checks the second registry, purchases the duplicate credit, and triggers the disaster. Without a unified network, the market creates an environment where duplicate credits can exist undetected. For the buyer, this means a significant portion of their ESG portfolio may already be compromised. Fixing this requires stripping out the analog infrastructure entirely. That is the function of the CRBN.credit intelligence terminal. It replaces the scattered, siloed databases with a single, unified retirement ledger. By utilizing immutable Web3 infrastructure, every retirement is permanently locked by cryptography. The unique hash of that exact ton is broadcasted to the network instantly, forcing it into the public light. Stop trusting manual data entry and start relying on mathematical certainty. Double counting is completely eliminated. For ESG managers and sustainability officers staring down on the 2026 regulatory deadlines, continuing to buy blind is a dereliction of duty. Protecting your corporate reputation and shielding your balance sheet from CORSIA fines requires undeniable, auditable proof of your impact. Stop relying on legacy registries. Open your terminal today at CRBN.credit. Do not let your net zero pledge become a regulatory liability. Verify your impact with absolute certainty.